The world of international banking is a mystery wrapped in numbers. With over 30,000 banks operating globally, these institutions manage mind-boggling amounts of wealth. To put it into perspective, the 10 largest banks collectively control assets worth an astonishing $25 trillion. Banking, though complicated today, began with a simple goal: to make life easier. Let's rewind to 11th century Italy, the bustling hub of European trade. Merchants from across the continent gathered to exchange goods, but they faced a persistent challenge: too many different currencies. In Pisa alone, traders juggled 7 types of coins, constantly swapping one for another. This exchange business often took place on outdoor benches, giving birth to the word bank, derived from the Italian term banco, meaning bench. The challenges of travel, counterfeit money, and securing loans prompted a revolutionary shift. Home brokers began extending credit to merchants, while innovative Genovese traders pioneered cashless payment systems. Soon, networks of banks spread across Europe, granting credit not just to businessmen, but also to kings and even the church. This marked the start of a financial ecosystem that would shape the world for centuries. Fast forward to today, and banks operate at the heart of risk management. Their role, though simplified, revolves around a vital process. Individuals deposit their money in banks, earning a modest interest in return. The bank then loans this money out at significantly higher interest rates. While this involves calculated risks, since not all borrowers repay their loans, it serves as the engine of economic growth. Banks channel idle savings into productive investments, enabling people to buy homes, industries to expand, and economies to grow. Beyond loans, banks derive income from a variety of services, including savings accounts, credit cards, currency trading, and cash management. However, the banking industry has shifted away from its traditional role as a provider of long-term financial solutions. Instead, many banks now chase short-term profits through high-risk ventures. During financial booms, they developed complex, often indecipherable financial instruments, and even engaged in their own speculative trading to rake in massive profits and bonuses for executives. This reckless approach had catastrophic consequences. Consider the 2008 financial crisis, sparked by banks like Lehman Brothers recklessly granting loans to nearly anyone interested in buying a home. This unsustainable practice created a housing bubble, and when it burst, the fallout was devastating. Stock markets crashed, and economies around the world spiraled into chaos. The crisis wiped out hundreds of billions of dollars, cost millions their jobs, and left countless individuals financially ruined. Banks, once seen as pillars of stability, were now symbols of mistrust. To prevent total collapse, governments in the US and Europe stepped in with massive bailout packages, purchasing toxic assets and stabilizing the financial system. In response to the crisis, new regulations were introduced to prevent a repeat of such a disaster. Banks were required to maintain emergency funds to cushion against future shocks, and stricter rules were implemented. Yet, not all proposed reforms made it through, as lobbying efforts from the banking industry watered down significant parts of the legislation. Amid this changing landscape, alternative financial models have started to gain traction. One such approach involves new types of investment banks that charge annual fees rather than earning commissions from sales. This structure aligns their interests with those of their clients, fostering trust. Another model is the credit union, a cooperative concept that dates back to the 19th century. These organizations provide similar services to banks, but focus on shared value over profit. Their goal is to create opportunities for members, whether starting businesses, expanding farms, or building homes, while reinvesting in local communities. Controlled democratically by their members, credit unions operate on a model that prioritizes collective benefit over financial gain. The cooperative nature of credit unions also means they are more cautious with risk, a factor that helped them weather the last financial crisis better than traditional banks. At the same time, crowdfunding has exploded in popularity, offering another way to bypass banks. These platforms connect borrowers with large groups of small investors. Whether it's funding innovative technology startups on Kickstarter or supporting creative projects on Indiegogo, crowdfunding empowers individuals to back ideas they believe in while spreading financial risk. Microcredit has also become a game changer, particularly in developing countries. Small loans, often given to people overlooked by traditional banking systems, enable individuals to start businesses and lift themselves out of poverty. What began as an effort to empower the underserved has now grown into a multi-billion-dollar global industry, proving that even the smallest financial gestures can have monumental impacts. While banking may not capture everyone's interest, its role in providing essential funding for individuals and businesses is indispensable. The question that remains is who will take on this responsibility and how it will evolve in the future, a decision that ultimately rests in our hands. Banks, once rooted in simplicity, have morphed into institutions of immense complexity and power. Yet their original purpose remains vital, channeling resources to those who need them, enabling individuals to dream, businesses to grow, and economies to thrive. To truly grasp their impact, one must consider how they influence every facet of modern society, from financing a modest home to supporting global industries. The seeds of modern banking, sown in medieval Italy, carried a vision of convenience and trust. Merchants then faced risks we now find unimaginable, journeys fraught with danger, counterfeit currencies eroding trust, and loans difficult to secure. But those rudimentary benches of commerce laid the groundwork for a revolutionary system. From Europe, the concept of organized credit, cashless transactions, and secure financial networks spread like wildfire, knitting together economies and creating an intricate web of interconnectedness. Today's banks are tasked with a delicate balancing act. On one hand, they safeguard our money, rewarding savers with modest interest. On the other, they lend this capital, often at higher stakes, to borrowers seeking to invest in homes, businesses, or education. By turning dormant funds into economic activity, banks propel societies forward. Beyond loans, banks generate revenue through diverse avenues: currency trading, managing investments, and overseeing the ebb and flow of cash in global markets. However, this ever-evolving role has not come without its pitfalls. Modern banks have strayed from their foundational ethos, embracing high-risk ventures in pursuit of short-term gains. During the financial boom of the early 21st century, speculative trading and convoluted financial products became the norm. What once was risk management transformed into outright gambling. The lure of staggering bonuses blinded many to the dangers lurking beneath these practices, culminating in one of the darkest chapters of financial history. The 2008 crisis remains a sobering reminder of what happens when the system falters. Loans given recklessly to unqualified borrowers fed a housing bubble that eventually burst, sending shockwaves through the global economy. The repercussions were swift and brutal. Banks collapsed, stock markets plunged, and livelihoods vanished overnight. It was a crisis born of hubris and greed, forcing governments to intervene with unprecedented bailout measures to stave off total economic collapse. Yet these interventions also fueled public outrage, further eroding trust in the financial sector. In the aftermath, governments and regulators scrambled to restore order. Stricter oversight was imposed, emergency funds mandated, and safeguards enacted to prevent similar catastrophes. But resistance from the banking lobby ensured that not all reforms took hold. This opened the door for alternative systems to rise, challenging traditional banking models and reshaping how financial services are delivered. Investment banks with client-first models and credit unions with cooperative principles began to garner attention. The latter, in particular, stood out for their emphasis on shared value and democratic control. Members elect their boards, and profits are reinvested into the community. This starkly contrasts with profit-driven banks, and it's no coincidence that credit unions weathered the 2008 crisis with far less damage. Their conservative approach to risk and focus on member welfare proved to be a robust defense against economic turmoil. Meanwhile, technology catalyzed another financial revolution: crowdfunding. Platforms like Kickstarter and Indiegogo democratized access to capital, allowing individuals and startups to pitch ideas directly to the public. This bypass of traditional banks empowered creators and entrepreneurs, fostering innovation while minimizing financial risk. For backers, it offered a sense of purpose, a chance to support ideas they believed in and become part of something larger. Microcredit emerged as yet another transformative force. These small, targeted loans, often granted in impoverished regions, equipped marginalized individuals with the means to build businesses and improve their lives. From humble beginnings, microcredit has grown into a global industry, demonstrating the profound impact of providing opportunity where it was once denied. Despite the criticisms and challenges, the fundamental role of banks to mobilize resources and distribute them efficiently remains indispensable. But the question of who will fulfill this role in the future is one of immense significance. Will traditional banks adapt to regain trust, or will alternative models take center stage? One thing is certain: the decisions we make today will shape the financial landscape of tomorrow. If you want to know the basic overview of anything, drop your intentions and thoughts in comment section and subscribe our channel to be omniscient.